Welcome to the Deep Dive, your shortcut to staying ahead of the curve in regulatory compliance. Today, we're digging into something pretty significant for insurance and reinsurance undertakings. It's a critical new development coming straight from EIOPA, the European Insurance and Occupational Pensions Authority. Our mission here is to give you the essential takeaways from EIOPA's latest consultation paper. It's on their draft implementing technical standards ITS, specifically focusing on resolution reporting. We'll unpack the core bits of the new directive, that's EU 2251, look at the key decisions they just made on reporting frequency and granularity, and, well, most importantly, what this all means for you as a risk manager thinking about your firm.
Exactly. And this isn't just, another box-ticking exercise. It's really a direct response, a strategic one, to the hard lessons learned back in the 2008 global financial crisis. The whole point is to beef up stability and preparedness in the insurance and reinsurance sectors, make things more resilient.
Okay, so let's unpack this from the start before we get tangled in the details.
Yeah.
Why? What's the foundational need for these new standards right now?
Well, you look back at 2008, and it really threw a spotlight on a critical gap, didn't it? There just wasn't a robust, tailored recovery and resolution framework specifically for insurers and reinsurers. And without that, well, managing potential failures smoothly, protecting policyholders, it becomes incredibly difficult. So these new standards, they're designed to plug that exact hole, give everyone a clearer roadmap for stressful times.
Right. The why seems pretty clear then, lack of a specific framework. Where does the actual legal push for this come from? Is it totally new law or building on what's already there?
It's driven by the new directive, EU 2251, specifically Article 12.1. That's the part that mandates insurers. It requires them to give resolution authorities all the info they need to draw up and implement resolution plans. So it's a definite legal requirement.
Not optional.
Not optional, exactly. And then Article 12 of that same directive tasks EIOPA, specifically, with developing these draftings, implementing technical standards, the ITS we mentioned. And these ITS, they're not just pulled out of thin air. They spell out the procedures, minimum standard forms, the templates for getting this information. What's quite interesting, though, is that EIOPA isn't completely reinventing the wheel here. They're building on the solvency data reporting framework, which firms already know.
Okay, so some familiarity.
Some familiarity, yes. And they're even drawing lessons from the banking sector's experience with resolution. But, and this is key, they're carefully adapting it all to the unique business models, the legal setups, and the specifics of the insurance world.
So EIOPA is doing that classic regulatory balancing act, aren't they? They need really detailed information for planning, potentially very granular stuff. But on the other hand, they have to be aware of the reporting burden this puts on insurers. That's always the tension. How are they trying to manage that balance here?
Oh, it's a huge challenge, a constant push and pull in designing these things. And they've given us some pretty clear signals on how they're approaching it. Take templates, LIAB1 and LIAB2, for instance. They could have demanded immediate gone concern adjustments for the write-down and conversion tool, the WDCT. That would be a massive ongoing valuation headache.
Yeah, that sounds intense.
Right. So instead, these templates rely on the going concern Solvency II SIG valuations firms are already doing. That significantly cuts down the immediate reporting workload. More precise WDCT info. That's only requested ad hoc if a resolution looks like it might actually happen.
Okay, so only when really needed.
Exactly. And similarly, they've said certain information, like detailed stuff on derivatives or issued securities, only needs reporting if those things are actually relevant to the insurer. It's about proportionality, not asking for data that isn't applicable or critical right away.
That practical angle sounds like a bit of relief, I imagine. Okay, so we've got the why. Let's shift to the what. What does this new draft implementing regulation actually require from you, the listener, the risk manager? What are the practical things you need to know for compliance?
Okay, so broadly speaking, all insurance and reinsurance undertakings, or if you're part of a group, it's the ultimate parent undertaking you'll need to submit information. You'll use the specific templates laid out in Annex 1 and follow the detailed instructions in Annex 2. It's also worth mentioning there are simplified obligations possible which can reduce the info needed for certain, maybe lower risk firms. A nod to proportionality again.
And how does it differ between individual firms and these larger groups? Who has to report what? Is it the same level of detail for everyone?
That's a really important distinction. Individual firms have specific template requirements, generally less extensive. They usually don't have to deal with some of the group-level templates focusing on financial interconnections or critical functions across entities. For groups, though, especially that ultimate parent undertaking, the obligations are, well, significantly broader. they have to report using a wider range of templates. These cover things like, how money flows between all the different group entities, identifying critical functions, core business lines.
A much wider view.
A much wider view, exactly. And often, this reporting is needed on both a consolidated basis, the whole group picture, and an individual entity basis, sometimes even broken down by member state where the group operates. It gives the authorities that really comprehensive overview of the group's structure, its potential weak points.
Okay, now here's the bit that probably hits home hardest for risk managers planning their work. Reporting frequency. This directly impacts workload, resources. What's the main rule EIOPA has set out?
Right, the core rule, this is in Article 3, is that the information has to be submitted at least every 2 years. That's the baseline. For individual undertakings, the standard deadline is no later than 16 weeks after their financial year end. For groups, they get a bit longer, 22 weeks. So it's not an annual pressure cooker.
Biennial. Okay, that sounds more manageable than annual. Is there any flexibility built in, particularly for that very first reporting cycle? Getting systems up and running takes time.
Yes, absolutely. They've thought about that. There's a specific derogation, a bit of leeway, for the first reporting period only. So for financial year ends that fall between January 30th, 2027 and December 31st, 2027, the deadlines are extended. Individual firms get 20 weeks instead of 16.
Okay, an extra month.
Yeah, and groups get 26 weeks instead of 22. It just gives firms that little bit of extra breathing room to get their data ducks in a row, get systems aligned. But, and this is really crucial to remember, even with that 2-year baseline, resolution authorities can still ask for reports more often or on an ad hoc basis.
Oh,
yeah, if there are material changes happening at your firm, or if they just decide they need more up-to-date info for their planning. So, the standard is biennial, but you need to be prepared for potential ad hoc requests too.
that makes sense. It leads nicely into data quality. What does the regulation, Article 4, I think, say about who's responsible for the accuracy and timeliness of this data?
Article 4 puts the responsibility squarely on the undertakings. It's your data, your responsibility to make sure it's good quality. If the information you sent in materially changes after you submitted it, or if the resolution authority flags issues with the quality, you have to resubmit as soon as practicable. It really underlines that even though the reporting might be every 2 years, the need for accurate, current data is continuous.
Okay, responsibility is clear. And what about the nuts and bolts, the reporting formats? Article 5 mentions specifics here, right? How fussy are they being?
Yes. Article 5 gets into the format details. The information has to be submitted in specified data exchange formats. And there are rules for numeric values, like monetary values should be in thousands, no decimals. Percentages should be per unit with 4 decimals. Integers just in units, no decimals. Generally, values should be positive unless the data point itself could be negative. And, importantly, if a piece of information isn't required for your firm or just isn't applicable, don't include it. Just leave it out. Helps keep the submissions cleaner.
Right, don't submit blanks if it doesn't apply. That's useful. But what happens if a resolution authority decides they need something really important that isn't covered by these standard templates? Can they just ask for more?
They absolutely can. That's covered in Article 6. It gives resolution authorities the power to request additional information that's not in the standard templates if they decide it's necessary for drawing up or implementing resolution plans. When they do that, they have to be specific. Tell you why they need it, the time frame, the format, and whether it's for an individual firm or the whole group. And there's a welcome little safeguard built in here, too, in Article 7. It talks about cooperation between the resolution authorities and the regular supervisory authorities.
To avoid asking for the same thing twice.
Precisely. They're required to check if the information they want is already available to either authority. The explicit aim is to avoid duplicating efforts for firms. It's a small detail, maybe, but a significant practical relief.
That cooperation piece is definitely a plus. Okay, let's shift focus a bit to the decision-making behind all this. How did EIOPA actually land on these specific requirements? I know Annex I, the impact assessment, looks at the costs and benefits. What were the big goals guiding those choices?
Well, the objectives were pretty broad, looking at the whole system. Things like enhancing preparation, coordination, cooperation between authorities, making sure they can actually meet resolution objectives effectively, also ensuring the internal market functions properly, a level playing field. And then more specific objectives like limiting the burden on lower risk insurers.
Right, proportionality again.
Exactly. And making sure policyholder protection is effective, efficient, plus promoting a consistent approach across the EU using these minimum harmonized rules. It's definitely a balancing act.
It really is. Okay, let's dive into one of those balancing acts. Policy issue A, reporting frequency. What were the actual options EIOPA weighed up for how often firms should report? What was the thinking?
It looked mainly at two options. Option 8.1 was annual submission. Straightforward, but the assessment suggested it would be pretty costly and burdensome for the industry.
A lot of work every year.
A lot of work, yeah. And also extra administrative costs for the authorities having to review all those reports annually. The upside, though, was potentially better crisis readiness, maybe faster improvements in data quality because of the frequent cycle. Then there was option 8.2 submission at least every 2 years. This one was obviously seen as much less burdensome for the industry. That was its main appeal. The potential downsides were, maybe slower progress on data quality, slower buildup of preparedness for authorities, and potentially more need for those resubmission requests we talked about if data got stale.
So, crunch time. What does this all mean for risk managers listening? Which option did EIOPA prefer for frequency, and crucially, why did they pick that one?
They went with option 8.2, reporting at least every 2 years. The main reason given was explicitly to reduce the reporting burden on insurance and reinsurance undertakings. It also lines up neatly with the frequency the directive already sets for updating the resolution plans themselves.
Consistency.
Consistency, yeah. And I think this decision really signals EIOPA understanding that asking for too much too soon can actually backfire. They seem to be opting for a more measured, let's get the basics right first kind of approach. Let firms and authorities get used to it.
That's a really interesting strategic point. Pragmatism may be winning out over maximum data collection initially. Okay, let's look at the other big policy issue. B, reporting on granular liabilities. This was about how much detail on liabilities aggregate level or right down to individual contracts. What were the choices there?
Again, two main options on the table. Option B.1 was no reporting on granular liabilities, so firms would only provide aggregate level information. This was seen as, again, less burdensome for everyone, industry and authorities. It meant a more gradual start to resolution reporting. The obvious drawback was authorities wouldn't get that super detailed view of financial interconnections for their planning. Option B.2 was the opposite, reporting on granular liabilities. Think contract level detail. Now, this would give incredible insight into those interconnections, what could be excluded from write-down or conversion.
Maximum information.
Maximum information, yes. But it was assessed as highly burdensome for the industry to actually produce that level of detail. And there was a real risk of just overwhelming the authorities with data, information overload, trying to make sense of millions of contracts in a crisis. Maybe not efficient.
So where did EIOPA land on this one? Did they go for the deep dive detail or stick with the higher level view for now?
They chose option B1. So no reporting on granular liabilities in this first iteration of the ITS. And the key reasons: proportionality, once again, and the significant burden granular reporting would impose right now. EIOPA clearly favored a gradual approach. Let insurers and authorities get comfortable with the new framework using aggregate data first. They can then, maybe, consider asking for more detail down the line once everyone has more experience. It's a deliberate choice. Prioritize getting the system working over getting every conceivable data point immediately.
Yeah, what really seems to come through from both those decisions, frequency and granularity, is this consistent theme. EIOPA trying very carefully to balance the undeniable need for robust oversight and crisis readiness.
That's just vital.
Absolutely vital. Balancing that against the real-world practicalities, the operational burden on the insurance and reinsurance industry, it really does look like a tightrope walk. And for this initial stage, they seem to be leaning towards a proportionate, gradual start.
I agree. It feels like a considered, perhaps more mature way to roll out significant new regulation. Get the foundation solid before building too high too quickly.
Okay, so let's wrap this up. To summarize for everyone listening, you should now have a much clearer picture of these new resolution reporting standards. You know what core information is needed via those templates. You understand the at least every 2 years reporting frequency baseline, the decision to hold off on granular liability reporting for now, and that all-important effective date.
Which brings us to a really important point for you, the risk manager. The regulation applies from January 30, 2027. Now, that might sound like it's quite far off.
Feels like ages away.
It can feel like it. But depending on your firm's financial year-end, your first reporting period could actually start quite soon after that date. So the message really is the time to start assessing your readiness, your data systems, your internal processes, how you'll gather this info. That time is now. Being proactive here, understanding not just the rules, but the thinking behind them. That's going to be key.
Absolutely. And that leads us to our final provocative thought for you to take away and think about. Given EIOP's clear emphasis in this first round on proportionality, on a gradual approach, How do you see these standards evolving in the future? What might the next iteration look like? And what long-term implications does the starting point have for your firm's data strategy, your IT infrastructure, and just your overall approach to regulatory reporting in the coming years? Something to definitely mull over.